Here's a question no Kiwi expected to be asking over their Weet-Bix this morning. Could Donald Trump crash the New Zealand housing market from the other side of the world? I mean, we're talking about tariffs, trade wars, and yes, the guy who once suggested nuking a hurricane, now potentially sending shockwaves through your mortgage. Helping us decode this global mess, we've got ASB's chief economist Nick Tuffley to explain how the New Zealand property market, interest rates and household spending might get whacked by an orange tidal wave of economic volatility.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button and get ahead, because this is New Zealand's fastest growing real estate and investment show. Nick, how exactly does a trade war in Washington start wrecking Kiwi house prices in Wellington?
Well, what we'll need to watch out for is, first of all, what does it do to our growth? Do people start to find that they're losing jobs or losing incomes or just being more cautious? So that'll be one part we'll need to look out for. And the other bit, of course, is that when it comes to housing, interest rates are really important. So what is Donald Trump going to do to New Zealand interest rates? And that'll flow on to mortgages. So we're looking at, so what for housing? Those are the two key channels we should be thinking about.
Is Trump turning the New Zealand economy into collateral damage?
We're likely to wear a little bit, but we're fortunate in that the direct tariffs that we've got so far with the US are about 10%. So, look, that's about $900 million worth of costs that would get added on to our exports or be borne by our exporters if they are sharing some of that burden. But we've got off reasonably lightly. For us, we're going to need to watch out for what are some of the indirect impacts that we have happening on us. So China has been whacked by a succession of tariffs. So it's actually going to be paying some quite high tariffs for whatever it exports to the US. So what does that mean for China's growth? Does China find other markets where it can diversify a bit to mitigate the impact? How much stimulus will the Chinese government give, for example, to just help the economy grow there? We are going to have to be mindful that a number of our key trading partners have been hit harder than most. So China's the big one. Even the EU's been hit by 20%, Japan over 20%, same for South Korea as well. So some of our key trading markets are being impacted by that. So let's watch out for that growth impact. So our initial take is look, New Zealand growth could be impacted by about 0.5%. Well, GDP could lose about 0.5% over the next little while through the trade impacts. But the other thing also to bear in mind is that we may find that even as our exports to the US become more expensive in the US market. For example, if we look at some alternatives, European Union wine is going to be hit harder than New Zealand wine. So do we have a relative advantage against some of those countries? If countries like China put big tariffs on US meat, which is basically where we're heading, does that mean that we have the ability to displace US meat in the Chinese market? So there's all those things we're going to have to think about too. And of course, what happens to some of the stuff we import? You can imagine right now, if you're making Canadian maple cerebral bacon and you can't sell it to the US, where are you going to be going? Oh, hang on, there's this thing called the Commonwealth. Let's see if we've got some more people that we can send our product to. And same thing, China will be very much doing that same thing, looking at where it can now send stuff. So we may find that we get some offsets through some stuff that we import anyway becomes cheaper as well.
How serious is the risk that these tariffs actually crash the New Zealand housing market?
I think we will find that, if anything, the dominant impact on interest rates in New Zealand is likely to be that they're slightly lower than otherwise. So that would cushion our market and could even mean that it picks up slightly faster. So I think we've got to look at how households going to feel about what's happening in the world. So far, we're largely feeling insulated. We'll find that it's, say, our meat exporters, our wine exporters are the ones that are probably most in the firing line for that. But generally, most households in New Zealand, I think, will find that they're not too affected by things, other than maybe a bit of confidence and uncertainty. And I think the balance of risks, if you're looking at interest rates, what's the Reserve Bank's job? Keeping inflation under control. And it tends to look at that sort of medium term. So say the sort of 1 to 2 year picture is what it can target. So in the short term, if you have import prices going up or down, it won't worry too much about those. It's more probably the effects that will show up with a bit more time. And that's likely to be let's say our exports get hit a little bit, we get reduced export incomes, slower employment, slower spending out of those export sectors, and that's probably over a sort of year to 2, 3 likely to dampen inflation more than anything else. So I would be thinking at the moment that the risks, if anything, are that interest rates could be slightly lower than otherwise just with what's been happening.
Could this trade war spike interest rates again just when Kiwis were finally catching a break?
I think for us, if anything, interest rates will be slightly weaker. The initial reaction has been quite telling around the world, actually, that interest rates have tended to fall. So to put in perspective, before the tariff announcement, financial markets for a long time have been pricing in that the official cash rate would get down to somewhere between 3 and 3.25%. So the initial reaction after a little bit of time to digest the more immediate moves, we've seen expectations for the official cash rate as priced into markets be below 3%. So markets are now saying there's a good chance that the official cash rate could go below 3%, potentially down to 2.75%. So again, I think when we're looking at what does this mean for interest rates, which is the big thing for housing market, if anything, well, market rates have already dropped a little bit, and that's certainly where the risks lie for the Reserve Bank when they make their decisions over coming months. So from the housing market point of view, that at least means the cost of borrowing, if anything, could be a bit lower, and that should help put a floor under the market here.
Just a reminder, your competition is already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart, subscribe. Let's talk real impact. How would these tariffs actually hit Kiwi families, home buyers, and investors?
Look, I think the fact that you've got different views is reflective of there is a bit of uncertainty around there, but look, the Reserve Bank's view is inflation, and if, yes, inflation pressures look like they'd be a lot higher, the Reserve Bank would be more cautious. But our initial take is that if anything, the risks are it's for a lower interest rates. So that would help cushion New Zealand, as would the exchange rate, which has been a bit softer. It help cushion some of that global blow to New Zealand.
If inflation's stabilising but global trade collapses, what happens to the average mortgage in New Zealand?
Well, one of the things we need to be mindful of around the world is just that fact that you've got a lot more uncertainty that's been creeping in. So yes, now we know kind of what tariffs are going to be in place, but now we don't know what sort of negative impact they are going to have. We don't know how long they will be in place. We don't know if people will be able to negotiate them down so that the impact is a bit less. Yeah, we again having to live with uncertainty, and that's always got that risk that we just hold back and don't make decisions in the here and now. I think when you're sitting in New Zealand and you step back, you go, well, for the vast majority of us, we probably won't be affected too directly by what is happening. And we may notice things in our pocketbook. So on the negative side, we may find that if you're buying anything from the US, that's more costly, particularly if it's being impacted by higher production costs within the US, if they're having to import some of the components, for example. We may find that some goods we get out of, say, China and other countries are cheaper and offset those impacts and help our wallets hold up as well. We've got a lot of things to work through. I think the thing that we need to take comfort from is that if things look like they'll slow down here in New Zealand, what that's likely to mean is a lower exchange rate to help cushion some of those impacts, and the Reserve Bank likely overall to be dropping interest rates more than otherwise. And that should help prop up our growth. So, look, I don't think we should get too, fearful of a downturn here in New Zealand. We need to be mindful of the risks, but also just bear in mind that there are things that will help mitigate those impacts, whether it's the exchange rate, interest rates, diverting our exports to other markets, or even benefiting from slightly cheaper imports from places where we may not have been importing as much as we may well do over the next year or two.
Are we being overdramatic here, or is Trump actually the biggest risk to New Zealand's housing market right now?
At this stage, look, we're not really considering changing that outlook that much. So there's two key things that will be driving decisions here in the housing market. certainty factors, look, I think we've been living with that for a little bit as it is. Income factors, how are they changing? For urban New Zealanders, probably not that much. It's some of the sort of provincial parts that may be a bit more dependent on, say, meat or wine, where there might be a bit more caution in there. But the big one is interest rates. And that's where our take is if anything, what Donald Trump is doing is likely to mean that New Zealand interest rates could be slightly lower than otherwise. And that's going to help cushion things. So at this point in time, we think that the housing market will still gradually recover over the course of this year and into next year. And if anything, like some of the dominant factors at the moment are just people have just been hesitant even before Donald Trump. We've seen housing turnover picking up very, very slowly despite how much interest rates have come down. And from a price point of view, prices have been pretty flat. And one of the impacts there is there's just simply so much stock on the market at the moment. So it's going to take a little while anyway for that stock to reduce. We need the sales turnover to pick up a bit more, stock levels to reduce, then we'll start to see prices move up. And I think those factors are going to be the really key ones, that and the slowing of migration as well, which is reducing one of the tailwinds for the housing market.
Thanks, Nick. It's been a pleasure talking to you.
Well, thanks very much for having me on. And yes, there's no shortage of things to be talking about at the moment.
Just a reminder, this channel is growing faster than your equity. If you think your property portfolio is valuable now, imagine what it could be if you had the latest strategies, insights, and expert tips before everyone else. Subscribe and make it happen.
More cash, passive income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial freedom's in your hands. Take that step, it's time.